DIV stands for Global X SuperDividend U.S. ETF. It was launched on the 11th day of March in the year 2013. This ETF tracks an index that selects 50 of the highest dividend-paying U.S. companies, including REITs and master limited partnerships. It distributes income every month to give investors a steady cash flow. As of the 23rd day of June in 2025, DIV had net assets totaling approximately $652.8 million and an expense ratio of 0.45% annually. The fund's 30-day SEC yield was 7.80%, and its trailing 12-month distribution was 6.41%. While the distribution rate stood at 7.54%, DIV holds around 50 companies weighted equally. Its top holdings each represent about 2.4 to 3.4% of net assets, including companies like Ardagh Metal Packaging, Philip Morris, Altria, Universal Corp, ATT, and Omega Healthcare. Investors receive monthly dividends. DIV paid about $0.08 per share each month recently, which equates to around $1.08 per share per year, implying a forward yield of around 6.22%. Its performance over the trailing 12 months was approximately 14.7% based on NAV and market price returns. Over 5 years, it returned about 15.2% annually. The fund's volatility places it at medium risk for its category, with a beta of roughly 0.71 and standard deviation near 14.9%. DIV's strategy involves selecting high-yield companies with low volatility, with sectors like financials, energy, real estate, materials, and consumer discretionary among its heaviest allocations. There are important caveats to understand. High dividend yields can sometimes signal financial trouble rather than strength. The Wall Street Journal notes that high-yield funds can erode principal over time despite attractive payouts. DIV has included companies with dividend yields between 6 and 20%, which can suggest caution. Distributions often include return of capital, which lowers your cost basis instead of giving you income from earnings. This defers taxes but can reduce your capital if principal is returned instead of earnings. Let us summarize using my meter rating across key categories. Income, 4 out of 5. A yield near 7.8% is well above average for equity ETFs. Growth potential, 2 out of 5. Focus is on cash flow, not long-term capital appreciation. Volatility, 3 out of 5. Medium risk stocks and equal weighting provide balance but still subject to market swings. Tax efficiency, 3 out of 5. Return of capital helps defer some tax but complicates cost basis. Simplicity, 5 out of 5. Easy to understand and trade monthly like any ETF. Total score, 3.4 out of 5. DIV is attractive for income seekers who want monthly payouts without owning fixed income or bond funds. It is particularly suitable for taxable accounts because of return of capital treatment. But be aware of the risk from elevated payouts, possible principal erosion, and limited growth. For growth investors, an SP or total market ETF may work better. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.